welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, for starters, the SGX Nifty is indicating a bit of a pullback, but we have been telling you all the stocks you need to focus on. So it's a good time now to get in some derivative strategies. Rajesh Palvia, the VP Technical and Derivative Research at Axis Securities, joins us on the show. Hi, Rajesh. Good morning. What do you have for us? It's going to be a bit of a tricky start to trade.
Good morning, Nigel. Yeah, so throughout the month, we are stuck in the range. Nifty is not going anywhere. It's trading in the broad range of 17,700 to 18,000, 18,100. Looking at the expiry setup now, we expect that, market is going to expire around 17,800, 850 zone because a lot of call writing activity was there around 17,900, 18,000 strike in the last two trading sessions. So looking at the overall setup, yes, these all levels are going to act as a major hurdle for the market. As we are getting that, negative opening, SGX Nifty is indicating that, we are going to have a gap down opening. But again, looking at the setup, the immediate support area for the Nifty is at around 17,750, 17,700, which is the major support area on the downside. So we'll take some contra bet to initiate a call ladder. It's a mild bullish strategy, call ladder strategy we will initiate. We will buy 17,800 call option, which was closed at around 89 rupees. And we'll sell 17,900 as well as 18,000 call option. So by doing this strategy, our net flow would be around 28 rupees. So we'll start making profit if Nifty manages to cross above again 17,830 zone. And if it remains below 18,030 level. So if it closes in this range only, then we will start making profit. So we'll take contra bet because we are going to open around important support area of 17,750, which is very important support area for today's trade as well as for expiry also. So we are expecting some pullback from those levels. That's why we are initiating here call ladder strategy. Moving to the stocks front, capital goods sector is continuously showing good strength. And looking at the overall setup, Siemens is looking very attractive, and the long rollover is happening in this stock. And looking at the overall structure, we believe that Siemens can continue further more upside. We are projecting target of 33.70 to 33.80 on the higher side. One can buy with stop loss of 32.60. Second stock is Voltas, very strong rally since last 3-4 weeks, and now stock is approaching above its immediate support area. So looking at the overall setup for the Voltas, we believe that this stock can rally towards 930, 940 zone. One can buy with stop loss of 885. Another stock is on the short side, that is Ipca. The stock is now trading near to its crucial support area. Looking at the derivative setup, we believe that furthermore short position can be there in the stock, and Ipca can go down further from the current level. 760, 750 are the next major support area where stock can go down in the continuation of this downfall. One can go short with stop loss of 820.
All right, Rajesh, thanks very much for that. That's a view on the market. And individual stocks, etc., as well that Rajesh wants to put out. All right, now we've got one more name on the Momentumizer segment. Vivek has got his eyes on Symphony. Vivek, take it away. Good morning.
Well, good morning. Well, this is keeping in theme, with the rising temperatures, and a lot of these companies are actually seeing significant interest as far as inventory build-up across dealerships are concerned. But first, having a look at, how the stock itself is trading and the stock internals, the stock is trading above the 50, 100 as well as the 200 DMA, up almost 6% in the last three trading sessions, despite the weakness that we've seen. And just, in 2023, the stock has gained almost over 20%. Now, some of the key con call takeaways, management sounded quite bullish as far as demand was concerned. What they did say is that along with newer models that they're launching, they're also tweaking, and making upgrades to some of the existing models. And what they're saying is that they're going to be taking calibrated price hikes, preparing for the upcoming summer season as well. What Goldman Sachs says is that the company is at this point of time set for an upbeat demand and strong volume traction in the coming months. Now, along with that, very interestingly, along with the results, the management had said that they have announced a buyback where where the share price, the maximum share price was set at 2,000 rupees a share, significant upside from the current market price, and the buyback was to a maximum of up to 200 crore. This is going to be done via the tender route. Lastly, some of the triggers that we've already been discussing, the rising temperatures, the heat wave warning, and likely El Nino effect this time around are something, that could see increased demand for stocks like this.
Okay, in fact, that's the next theme as well, right? I mean, rising temperatures, a heat wave perhaps could result in more people consuming more power, sitting in their homes, consuming more in terms of air conditioners, etc. As Vivek was pointing out, the Power Ministry has said that they have invoked Section 11 of the Electricity Act to meet that expected rise in power demand. They expect peak electricity demand of 229 gigawatts in April of 2023. So everything ties in, I guess. Harshvardhan Dole is joining in, talk more about that. Harsh, there's also a lot being done by the government to avoid power shortages. Tell us a little bit about what this means for the industry and which are the listed stocks that could be beneficiaries of this.
Well, firstly, I must compliment the government for the pragmatism that they're currently showing. It's good that, even before the summer is yet to hit us, preparedness is underway to ensure that there are no power outages or, there is scrambling for power. And to that extent, invocation of Section 11 or asking utilities to import coal is a step in the right direction. What is surprising is on a higher base, the power demand growth has sustained in double digits. So, all fingers crossed that such momentum continues and such preparedness kind of, works in favor for the whole sector. From a stock perspective, I think what we continue to like is the utility space, the regulated ROE companies, which are currently operating their plants at nearly full throttle and who are well placed to pass on all the cost variation to end consumers. So we'll prefer to play this whole theme through the regulated entities like NTPC and HPC Power Grid, where at least cash flows are more or less secured.
So, I mean, unlike the last couple of years, right? I mean, summer season, the usual headlines start to come through. Coal stocks running low at power plants. Coal stocks worth only this much. Power demand is through the roof. I mean, that was a big one last year as well, the year before as well. So you think, Harshvardhan, this year should be more, we will avoid that kind of a situation?
Well, the preparedness from the government surely indicates that there is willingness to, address the peak power situation well in advance. For example, the CERC stance to create a parallel power market whereby, utilities can buy power up to 50 rupees a unit will certainly prompt, gas-based power plants or even certain imported coal-based power plants to take risk and essentially sell power on that particular, market. And since in these markets, margin has to be provided well in advance, I think there is incentive for even some generators to take this kind of risk. So in my opinion, the structure of the market is turning more favorable towards the generators incrementally, which is actually very good.
All right, Harsh, morning. You mentioned three stocks. That's NTPC, NHPC, and I think Power Grid. What are the target prices you have out there? Yesterday, in fact, NTPC was an outperformer.
See, NTPC to us is absolutely a no-brainer. It is the largest generating entity in India with a solid, formidable balance sheet. And it can potentially keep on adding 6,000 to 7,000 megawatt of capacity each year for a protracted period in time to ensure that India continues to get 24/7 power. The valuations are even now, after a massive outperformance, are undemanding. You're still getting the stock below 10x on 1 year forward earnings. And the dividend yield is pretty impeccable at, say, 6% plus. And the best part is the capital allocation from a utilities perspective is changing positively. So all indicators are turning green, and therefore we continue to like that stock. Our near-term target price on NTPC is 200, which will keep on progressively revising upwards.
Okay. What about exchanges like IEX, for example? What is the outlook over there? The power exchanges?
See, as an exchange, we like the business. My colleague who covered the stock is a bit mindful of the valuations. And, perhaps when valuations become more attractive, as a house, we may turn more constructive. But as a business, that's a good business with solid, tailwinds.
Okay, Harsh, we'll let you go on that note. Thanks a lot for joining in and giving us a quick take on what's happening in the power space and the way forward for that. Well, in pre-opening, the market is very, very quiet. So just about adjusting. I think we can get some rates in as well. Remember, we'll get you our exclusive conversation on Tata Power with Praveer Sinha of Tata Power. That comes up at 10:15 a.m. on Bazaar today. So do stay tuned in for that. But in the meantime, let's get some 9-10 calls going as well. Sudarshan, what would the big call be at 9:10 this morning?
See, the Nifty is a short sale with a stop above 17,850. Granules is an intraday short. Keep a stop above 290.
Mitesh, what about you?
I'll go with a sell on Bandhan Bank. Keep a stop at 235. Look for targets of 214.
Okay, that's a sell on Bandhan Bank, you said, right? So there are a couple of stocks in focus. We thought let's just get them on board for you. Now, the IMD, as we know, a couple of days ago warned of the first heat wave of the year in the month of March. And they said that parts of the western region could reach even 37 degrees Celsius. Now, this is great news for a lot of the white good makers, whether it's Voltas, Symphony, Blue Star, all of these companies would benefit, and hence you're seeing a bit of a green tick over there. Jefferies put out a note on Voltas where they have a buy and aggressive target price. 1,050 is their target price. 890 is where the stock is currently. They said that the early heat wave points to an improved volume and margin outlook for Voltas. FY24 should see both the AC and the engineering segment being in a sweet spot. The other benefit is Voltas has underperformed the Nifty in the last 1 year. There's a 1 year underperformance, hence there could be more headroom for the stock, and hence Jefferies is quite bullish on Voltas.
I mean, we've been kind of highlighting and talking to guests actually. This is the AC stocks, right? But the consumer durable space has been such a huge underperformer for the last year and a half or so, and that includes other kinds of companies as well. I mean, Whirlpool, V-Guard. I mean, that entire space has been completely bashed out of space. So starting with AC, perhaps a little bit of interest coming back into that space once again. But oil and gas in focus, and why Sonal is here to put the spotlight on it once again. Sonal, hi.
Hi, Prashant. Well, a couple of reasons. First, crude prices, they have fallen overnight by around 1%. There are demand concerns globally. Of course, the rate hike phenomena that we're talking about is hurting equity and commodity markets as well. So right now at $83 per barrel, we are talking about demand coming back from China, which could support crude prices. But for now, we are seeing some declines here. Additionally, we have a bullish note coming in from Morgan Stanley. This is for oil producers, and they say that they maintain non-consensus overweight on Indian energy producers. This is because these companies are talking about raising their production at a time when global peers are talking about declining production and weaker demand as well. A government policy that we've been talking about is underappreciated according to Morgan Stanley, and capital return story is highly attractive. For them, ONGC and Oil India are key picks here. They have an overweight trading on ONGC with a target raised to 199 rupees per share. For Oil India, target is raised to 323 rupees per share. So these stocks are in focus.
Okay, thanks a lot for that. Well, just a couple of minutes, I think a minute or so before we get to market opening. Keep an eye out on Prestige Estates as well on the back of very bullish commentary from the management. They expect their Mumbai sales to double. They've had an analyst meet in Mumbai. So this is clearly the residential market that Prestige is targeting. That stock is in the green. You have BEL, where they've signed that MOU as well for some combat aircrafts. BEL is also in the green this morning. And then, a couple of other names, Mirza International, Delivery, etc., also in the green at the moment. So for the market overall, you have the Nifty has been in a very, very tight range. So perhaps continuing to face a bit of a hurdle at that 18,000 mark, and the flows have also been on the muted side. So this morning, the SGX Nifty and the pre-opening levels are indicating that there would be a 70-point fall. Remember, the Nifty is below the 20, 50 and 100-day moving average. So it looks like, it would be a bit of a cautious opening. 15 seconds left. We're also waiting for what happens with the Fed minutes that come out later in the evening. And the Dow Jones is now what? Negative for the year. So, you know, there's quite a bit of a cautious move over there. But let's get the first tick on the index. That's the market opening for you. The Sensex is down about 300 odd points. The Nifty is down about 70 odd points. And the mid-cap index also under a bit of pressure. The mid-cap index now down about 0.4%. The Nifty Bank is facing a bit of heat, so that's down almost 0.4% as well. And in fact, now the Nifty Bank is just holding above 40,400 by the skin of its teeth. It's not looking good for the broader markets too. The Nifty mid-cap index is down almost about 0.4% too. What's taking it on the chin this morning is IT stocks, TCS, Infosys, Wipro, HCL Tech, all in the red right now. A couple of other heavyweights like HDFC are also under pressure, down almost about 0.7%, and banks. So today the pressure is coming in both from IT and banks, which is not a good thing for the bulls. Axis Bank, SBI, Kotak Mahindra Bank are all in the red. The advanced decline ratio, by the way, is now well in favor of the declines at over 1,070 stocks. So it is definitely a weak opening. Banks and IT are under pressure. Consumption stocks would be interesting to see how they are shaping up, but not too good in terms of moves coming in on HUL and ITC. Overall for the market, it's a bit of a setback this morning, you'd have to say. Banks exerting some more pressure now, down almost about 0.5%, and the mid-cap index also taking it on the chin. So you'd say down, but not out for the market.
Well, that's right, Sonia. And a few stocks that continue to remain in focus. NMDC, well, that's up close to around 5%. That's NMCC Steel. So it's listed, and post that, we're seeing quite a lot of interest. We'll have the management in just a bit talking about NMCC Steel plant. So for starters, that's locked again in upper circuit. The other couple of names, you have Adani Power, that's opened yet again with a gain of close to around 5% or thereabouts. Imami, well, articles in that have come out earlier today indicate that they're looking at gross margin expansion. But I think for starters, Imami is more or less flattish. They're expecting, EBITDA margins to move back to pre-COVID levels. So Imami is probably a stock you should keep an eye out on. Everready, well, they as well are indicating that they're seeing higher level of growth in the quarters ahead. So that's another probable stock that you should keep your eye out on. And Peninsular Land, we normally don't talk about this one, but that's up close to around 8% odd. Small 400 crore market capitalization company. Reports indicate that the lenders have reached a settlement. They have withdrawn the insolvency plea against the company. And that's why I think that smaller name, Peninsular Land, actually it's locked in upper circuit, I think, with a gain of close to around 10% odd. So not much happening besides these few movers. But the Nifty, if it can defend the 17,750, 17,740 for the first hour or so, it'll give the bulls some bit of hope that they can fight back later on in the trading session. For starters, we're down, but I don't think we're out yet. Prashant.
And the low now is what, the low today is 17,744. We're about 20 points off it as things stand right now. So it's about 60 points lower. A few other names. So Ambuja Cement starts about 0.5% in the red. There is Persistent and LTI Mindtree, which are down. I mean, Tech, NASDAQ was down 2.5%, so there will be some rub-off because of that. Zensar Tech is another one, but these are smaller names, much smaller names, which are down. Shilpa Medicare is down 3.5%. That one has had very large moves, one-day moves for the last few. Nykaa starts about 1.25% lower. Torrent Power is down about 3%. There is Hindustan Petro, HPCL down about 1.25%. Info Edge starts down about 1.75%. Against about LTTS, which is down 1.8%. Happiest Minds, Emphasis, lots of tech, lots of mid-cap tech basically, which is down. Market breadth is 2:1 in favor of declines at this point in time. Volta starts 1.6 higher. So, the AC theme with the oncoming summer. Gland is up about 1%. There is Mirza International, which is up about 2.5%. Triveni Turbine came up yesterday. You've got Tejas Networks, which is up about 2.75%. Volumes are still slow. So I think let's give it some more time before we get back and look at this space once again. But a lot of stocks moving around as always. All right, Rahul Arora is now joining us. He's our market master of the day. He's, of course, CEO in Nirmal Bang Institutional Equities. Rahul, great to have you with us here. Thanks very much. How are you feeling about the market first up, Rahul? Are things changing at the margin a little bit from people trying to buy the dip to trying to once again, that old sell the rally kind of sentiment coming back? Not here in India so much so, but globally.
Morning, Prashant. Thanks for having me on. So I think from when we spoke in early Jan, I think 3 or 4 things have visibly changed. I think a lot has happened in the last 48 hours. I think the US president's surprise visit to Ukraine and Putin suspending the treaty, the arms treaty with the United States. So I think that the data point is old, but then the question is this going to have another refresh? And what impact could this have on global commodities? So I think that's the first. The other is the commentary that the Fed is expected to give out tonight. I think is expected to be higher for longer. And that could be a bit disturbing. I think the third data point is our very own CPI that came in, which was very disturbing. And I think now the market is probably factoring in another 25 basis point rate hike. And the fourth, I think, Prashant, is an entire earnings season's gone by. And we were just doing an analysis in our broking house. In fact, it takes off from what you were doing on the channel yesterday. And, we saw that about 50% of our stocks earnings have been downgraded. And about 20% have been maintained. It's only about 30% that have seen an upgrade. So I think a combination of an overall disappointing earnings season, a fresh refresh of what could happen in Russia and Ukraine, and the fact that inflation and interest rates is a bother both in US and India. I think this is going to cap any sort of upside. Now, could this become a sell-on rise? I'm not entirely sure, but I don't think the market has any reason to go to 18,500 or even beyond that. I think if anything, a trade has to be taken now. I think it's probably more on the downside than it probably is on the upside. And the last data point I'd like to mention is, I think, because I look at the consumer sector very closely, I think if you look at consumer staples, consumer discretionary, consumer durables and electricals, the numbers in the last 4 months post-Diwali are coming off. So this quote-unquote wealth effect may also be waning at the margin. So I think the market needs some very strong positive data point to push it up. On the face of it, it doesn't seem to be there, which leads me to believe that the tilt could probably be more towards the downside than the upside.
The only thing with that argument is it's sort of like a consensus view, right? And the market never obliges with a consensus. So let's see how it shapes up. But for now, I take your point. I mean, when the world's largest retailer, Walmart, talks about a 2% growth next year, then wonder what's going to happen, lower down the cycle. But what do you do with consumption stocks then? Especially the guys who are present in the rural or tier 2, tier 3 cities. Do you avoid it entirely, or do you look for some opportunities here?
So I think the fact that layoffs are happening in most parts of the world is a reality, and that's going to have an impact on consumption everywhere. I think even if you have not been laid off, I think the fear of that happening, particularly in the Western economies, is very large. And I think one of the largest banks in the US, for example, yesterday has just put out, Morgan Stanley put out a note saying that they see the S&P falling by 26%. So when you have such kind of data points, obviously it has an impact on consumption. On India specifically, I think the volume growth was nothing to write home about in the third quarter's results. I think a lot will depend on government spending and the kind of projects they're able to announce and the labor it's likely to be generating. Hopefully, we have a good monsoon, but my sense is that probably the time to buy FMCG or consumer staple stocks will be after the next quarter's results. I still think they're priced for perfection. We've seen that in some of the consumer names and the impact they've had. The only interesting point, Sonia, and I think if I'm sure you tracked Manisha's link on CNBC the other day where wheat prices are off 30%. And for that, you've seen the impact on a stock like Britannia, which is doing well. So I think on a case-to-case basis, where you have reason for raw mat prices that are coming off and that's going to show you margin expansion, it's going to be great. But I think top line is going to be a challenge, and not just in staples. I think even if you look at beyond staples, stocks like V-Mart, Bata, they're all struggling on the top line growth at this point in time. So I think one more quarter probably, and then I would buy. I think it's a great proxy to the Indian consumption story is consumer staples. The kind of return ratios that they operate at and the kind of cash flows they have, only IT and FMCG in India have that. So maybe another quarter, and then I'd definitely look at entering consumer staples.
All right. Hi, Rahul. Talking about the consumption angle, my co-anchors have been talking about the scorching heat that we're bracing ourselves for. And there are a couple of ways to cool down, right? One is the air conditioners. The other one is beers, I'm guessing. What's your view on both these two pockets? Voltas has been doing well, and the numbers are very, very disappointing. It's been a big underperformer, but clearly there's some pre-buying that's taking place. If not at the stores, then at least on the share counters. Your view on the space?
So I think the summer has onset a little too quickly. I think even when I talk to my family and friends in Delhi, it started to get a bit warmer, which is a bit surprising for the month of February. Yeah. So obviously there's a lot of anticipation that inventory stocking is going to happen, and you'll probably see that growth come through, not only in the next quarter, but maybe some evidence of that in this quarter. I think for a lot of people, the point I was making earlier on consumer staples, I think in some pockets, commodity prices have definitely eased off. Yes. And that's likely to probably aid margins. I think we're we'd probably look for players that are gaining market share, something like a Blue Star, which has definitely given out a printed market share, target that they have, and they're already at about 13.5%, 14% or there and thereabouts. So I think on Voltas, obviously the people are waiting for the demerger to happen if and when it happens, and I think then the consumer business will probably get re-rated dramatically. I don't know if and when that happens, but definitely we'll look at names like Voltas and Blue Star. Maybe Blue Star more than Voltas. I think the return ratios are also picking up dramatically for Voltas, for Blue Star, and I don't think the valuations are demanding at all. So I definitely look at those two. I would probably avoid the Whirlpools and the IFBs because I think the presence in air conditioners is much, much lower. They're slightly more hardcore refrigerator and washing machine plays, but I'd look at those. On the liquor side, I think United Breweries was really, really disappointing on the results. I think, I can't remember the last time they came out with such a bad set of numbers with margin compression. My tilt would probably be more towards United Spirits at this point in time. I think United Breweries is going to struggle. There are route to market concerns in both entities. I think in United Breweries it's showing up a little bit more because some of the key markets, particularly in the south, have changed their route to market, and that's going to have an impact on business and volume growth. But I think if you look at the return ratios for UB and UNSP, they're probably half of what a consumer staples is, and the valuations are not too different. So I think probably if I was to take a slightly more structural call, I'd tilt a little bit more towards staples than towards liquor. But for the AC manufacturers, for sure, and I'd probably say Blue Star 1, Voltas 2 in that pecking order.
So you like ACs and you like beer. That's a great combination.
They're not essentially mutually exclusive. You consume one in the presence of the other in most cases. But, I think, like I said, I think probably United Breweries would probably be an avoid for some time. UNSP, I'd probably look at nibbling in at dips. But Voltas and Blue Star, I'd definitely look at buying even right now.
Yeah. And this, the headlines on summer, it's like, it's almost every year. I mean, the onset of the summer is earlier this year. I mean, I think you can find that same headline, for the last 10 maybe. But I don't know. It perhaps is, global warming and whatnot. But let's come back to specific stocks, Rahul. You guys put out a note on Mahindra Corp, right? Not very enthused by what they are trying to do. And I completely agree with that point. Just, you want to talk about that? What's the rationale, what's the reasoning, and how do you look at that transaction?
So I think what they're trying to do is the right thing. I think the way they've probably gone about doing it is probably, a question mark. I think any company that has cash on books, either you invest that capital into your existing business and grow it, or you look at an adjacent business to acquire and sort of, grow your business that way. So either organic or inorganic. But I think while the Mahindra Corp management says that it is an ancillary business to them, and it probably makes sense because they are a competitor. I think a financial investment in another auto eyeing company, I'm not so sure. If they had come in as a strategic investor and business partners, it would have made far, far more, business sense. I think I'm not sure. So now the fortunes are linked to the stock price of pre-call, effectively. And our call is that at a time like this, could there have been a better investment for that money, as simply put as a fixed deposit for that matter, or a 10-year GSEC where you could have got the yield on that. So, when you're a financial investor, you're basically a stock market investor. And I don't think that's probably the best use of capital. See, it's a 28% return on capital employed business is Mahindra. The return on equity is about 16, 17 times. And before this deal happened, I think the valuations were at about 14 times. So it was not like it was coming to you at a substantial discount to many auto component companies. Some that have a larger export-oriented thrust, like a Sona or an Endurance, etc., will probably go at higher multiples, but they have their own challenges to deal with in Europe. But I think the fact that it's now by and large linked to the stock price of pre-call, as opposed to taking a business interest and having a seat at the table, we just felt that for the kind of return ratios that they had and the kind of capital allocation that they've done, a slight P tweaking was required, and therefore we had to change the view on the stock. Obviously, if the stock price of pre-call does well and they get their return on investments, but then it's like playing IT for rupee depreciation. Is that what you want to buy it for? Okay. That's the thought.
All right, one last question from my end, because the flavor of the season is weddings, right? I mean, the kind of hotel bookings, airline travel is at a record high, and we've seen this whole wedding season sort of blow up, I think the highest in the last 4-5 years. This space, whether it's hotels, aviation, do you think it's good just for a trade, or is there some long-term potential here?
So I think the businesses are definitely into a new orbit, but I don't think they have room to squeeze from here, particularly on rates. I think if you look at the listed entities, right, which is the Taj Group, which is Indian Hotels or East India Hotels through Oberoi, and even if you track the other room rates just on Make My Trip, which is something that we do, I don't think the hotels have too much room to increase ARRs, and I think the cost savings have by and large been factored in. Even for aviation companies, I think they're not going to be able to push too much more on price increases from here. So it's basically going to be on cost savings and operating leverage that comes through as a result. Paying 23, 24, 25 times 1 year forward EV EBITDA for these guys now looks a little tricky, because I think the trajectory, as I was saying a little earlier, I think if you see consumption trends coming down post Diwali, I'm not sure that these kind of numbers can potentially sustain. Hotels are a cyclical business, and I think an entire cycle has got captured too early in the stock prices of these entities, right? Indian hotels went from 70 to 350 in a matter of 18 months. So I think for a lot of these guys, the best may be behind. I'd still probably, if you're looking to play discretionary, move away from hotels and aviation to certain QSR players that have actually underperformed. And I think that may not be a bad way to look at it, because I think the return ratios and the valuations in QSR are a little better than they would be in some of these other discretionaries like airlines and hotels. So if you've made your money, I'd definitely look at making a switch there.
And I think you made that point the last time as well on hotel stocks. Maybe the best is behind. I think some of them have corrected from the top. So good on you. Thanks so much, Rahul, for coming down to the studio and in fact giving us your view on a whole host of sectors as well as the approach to the markets. Well, let's shift focus then to another theme. Cement stocks, they've been moving around. Well, there are reports that there are a price increase that's been pushed through in the past 10 days or so. However, some contrary reports came in yesterday that maybe some part of those pullback of those prices have been pulled back. To understand what's the outlook out there, we are joined by Mr. Bangur, the MD at Shree Cement, who joins us on the show. Hi, Mr. Bangur. Always good speaking to you, sir. And thanks so much for speaking to us here on CNBC-TV18. Well, give us a sense in terms of pricing. We're getting conflicting reports that a price increase was tried to push through. But then, post the restart of ACC and Ambuja cements in Himachal Pradesh, some of the neighboring areas, we understand that the price increase have been pulled back. Just to understand, what is the average price now that you compare it with Q3 FY23? Go ahead, sir.
In fact, because of the closure of ACC and Ambuja for quite a long time of more than a month or so, still the price were not affected. The prices were flat compared to Q3, even before the closure and even after the closure. Only because of the seasonal variance, that is in March to June, good demand is there. So now the ground reality is that the prices should increase because of good demand. Almost all companies are having 100% capacity utilization. For example, yes.
Yes, Mr. Bangur, all demand is strong as per what reports indicate and going by what you're saying as well. But just to press on the point on pricing you're saying in Q4 is still flattish in comparison to Q3?
Yes, I am very clear that it is flattish. Some places the price may increase a little, some places it will decrease. Okay. But it is expected that from March onwards, when the peak season starts, when the budget starts ending and everybody has to spend money, then the really demand should pick up. So I think still we are about a week away from some price rise.
Okay, all right, got that point. So as of now, it's flattish, but you're optimistic that price increases will be pushed through. Now, you have added capacity, and for the first 9 months as well, you have given, good growth on the volume parameter. Could you tell us what do you end this year with in terms of volumes? And what about FY24? What kind of volumes will you be looking at?
This year, in third quarter, our volume growth is superb, from 65 lakh tons to 77 lakh tons, roughly 18% growth in the third quarter. In fourth quarter last year, we were 80 lakh tons. So there is not much scope as our capacity will be limited. We will be ending up with 10% increase in the fourth quarter, 88 lakh tons or so. But in coming year, we are hopeful that our new digital initiatives have taken place. New marketing setup is there, management changes are there. So we expect about 36 million ton in the coming year.
That is FY24, Mr. Bangur?
Yes, that is FY24.
And you said FY23 you will end with what?
About 30 million tons.
About 30 million tons. Okay.
So I am talking about 30 to 36, a tall call.
Okay, 30 to 36. So give us some qualitative analysis, right? I mean, where are you seeing an improvement in demand? Is it more, a lot of it is coming in from private capex, or is it still government capex, infrastructure, real estate? Give us some, nuance on what the next trigger would be for you in terms of big demand.
Demand will be increasing only at the pace of 8 to 10%. That is basically because of the government demands. Government is pushing for infrastructure. People have money. So personal housing in the small cities and the villages is also picking up at a good pace. Real estate sector is doing well. The stocks with the promoters have come down. So all the factors are in the same side, that is positive. With this, we expect 10% the industry growth, and Sri will catch up. Our capacity utilization was low. Now we will be at par with the industry with 36 million tons next year.
Okay, all right. So you're going to grow at twice what the industry grows, and you have the capacities as well coming on stream. So operating leverage will play out, right? Mr. Bangur, what's been disappointing in the last few quarters, you've gone through some difficult times because the EBITDA per ton, it went down to around 700 rupees in the previous quarter. It's recovered to close to around 900 rupees. What is the improvement you're penciling in, say in quarter 4? Will it improve by 150, 200 rupees or more than 1,000 rupees?
No, in quarter 4 there should be little increase, but we expect that from first quarter next year, we have now committed our coal purchase. The prices have come down of coal by about 10 to 15% compared to the third and fourth quarter. So there should be that much decrease in cost.
So your EBITDA per ton by the first quarter of FY24 goes back as of current reckoning. If things change,
yes,
price increases don't go.
And I expect 4 figure.
So 4 figures you could get to in this quarter itself because you're going to be growing by close to 10%.
4 figure in this quarter may be there, but next quarter onwards, I am little conservative as always, but it should be much better.
1,200 rupees per ton? 1,100 to 1,200 rupees?
Maybe it's not impossible.
Okay, 1,100 to 1,200 is not impossible.
EBITDA, to say EBITDA, you are predicting too many things. You are predicting at what cost it will be sold. In a commodity industry, to talk about EBITDA is the really most difficult thing. It is overconfidence. We can talk about our costing, we can talk about our volumes, but EBITDA is totally dependent on the market.
Entirely, and we take your point about how demand is definitely picking up, so that will of course flow through into your EBITDA performance as well. Wanted to understand, will all your growth in the next 1 to 2 years be organic, or are you looking at any kind of inorganic moves as well to achieve this 80 million tons?
Till next year is too short a time about talking about takeover and others. Our growth will be primarily in next 1 year or so will be what is there in the pipeline, and we are committing more capex. But in a 3-year period or 4-year period, definitely we will be looking at turnovers, takeovers. Right now, we are not sure which company it will be or which area it will be.
Okay. All right, Mr. Bangur, final question before we let you go on this. I want to ask you, because in the past, we have seen personally you've made some investments in other companies. So whether it's with regard to Orient Cement or the likes. What if you were looking at ACC and Ambuja Cements, when it was up for grabs? What would be the realistic valuation? Some on the street believe that it was a good asset around $170 odd. Some believe it should have been around $200. Some it should have been a little less. What's your take?
No, it's up to the individuals how aggressive they may be. I think the deal was done at a fair valuation.
Fair value.
And it became cheaper because not much public holdings have come back to the promoters. So effectively, the cost was lower than expectation.
Okay. Would you, in hindsight, would you have bid a little bit more aggressively?
We don't have that much pocket to take over that big a company, and they would not have sold it in the piecemeals. So the question is highly hypothetical. I have no answer to it.
But you believe that the deal at least got done at a fair value. So I wanted that perspective from you, Mr. Bangur.
Yes, it was quite a fair value.
Okay. All right. All right, Mr. Bangur, thanks so much for stopping by and filling us in with all those details. You've given us a fair outlook in terms of volumes, EBITDA per ton, as well as your view on the cement space as well. But one stock that's been doing well in the last few days has been NMCC Steel. Now, from the day of listing it, at around 31 rupees, it's been moving in upper circuit. Well, there were plenty of details that the street was waiting for, so I caught up with the management, and let's hear out what they had to tell us. Mr. Sumit Dev, the chairman and MD of the company, discussed a whole host of issues. Let's hear him out.
So the steel plant has taken some time to get all the facilities ready, but we have now currently the coke oven battery 1 is already in operation since October. We would be able to start the sinter plant very soon, in a couple of days time. The coke oven batteries 2, and obviously a steel plant needs to have various phases, various units which get commissioned in phases. And next would be the blast furnace and the steel melting shop and the thin slab caster, which we expect to commission end of March, April, beginning of April.
Okay, all right. So by April, we'll have the steel plant finally getting commissioned. Are we getting that correct?
Yes.
Okay, so what should be the rough number in terms of volumes you're looking at for FY24? It's a 3 million ton plant. Given the ramp up could take some time, what would be the realistic production volume you're looking at?
So currently, once we start commissioning, this commissioning process, the contractors who are the prime contractors of each of the units, they commission it, and they do the commissioning part, and then we take it over. So they have to ramp it up to 66%, and then finally once it reaches that capacity, we take over the units one by one. So I would think initially we would just be starting the plant, and however, having said that, the coke oven batteries are already, the commissioned and taken over. We have taken over the coke oven battery 1, and then is the center plant. So I don't think I can give you a number at this stage with regard to production, but definitely a million ton, million and a half. So would be a million ton would be the correct picture.
So at least a million tons is what you could do in FY24.
Yes.
And you said that it needs to ramp up to around 66%. When does that happen? Quarter 2, quarter 3?
So that it takes almost a year's time to any steel plant to stabilize and run properly. It takes a year, almost year and a half.
Okay, all right. Let's focus then on the capex. How much have you already spent on this particular unit? Point number 1. Point number 2, how much more do you need to spend? And point number 3, give us the updated debt number.
So currently, we have almost done 21,000 crores is what we have spent, and balance we would be spending around around 2,500-3,000 crores, which would include the raw material for the commissioning of the steel plant. And the debt is around 5,000 crores is what we would ideally be looking at over a period of time.
Just to get that debt number correct, sir, I understand that the current debt is close to around 2,800 crores approximately. So you're saying once it gets commissioned, the peak debt will be close to around 5,000 crores.
That is correct.
All right. Seems fair then. So at what level does this unit break even though? If you could give us a rough sense, you're looking at a million tons, which will be, low capacity utilization level. But in FY25, I'm guessing that it ramps up. So at what utilization levels can it break even?
So what happens normally in a steel plant, it takes at least a couple of years to get it ramped up and reach that level of utilization where it gives us some return. So the quicker you try to do it, the better it is. But so it will entirely depend on the sort of ramping up process and the time it takes. So the less the number of years, I think 1.5 to 2 years is at least the minimum period where we will not be able to make any money on it. So after that, subsequently, probably it starts giving returns.
Okay, all right. Now we have a discovered price, sir. In terms of the stock market, because it's a listed company, we have the rough rate out there. Now, NMDC was supposed to buy close to around 10% stake in this venture. What's happening out there? Have you all fixed the price? Will NMDC be buying that 10% or more or less?
So this is the process which is being run by the Disinvestment Ministry, that's DPAM. And yes, 10% is what NMDC will have to buy at some stage of. And having said that, we have not yet come to the pricing of the shares.
Okay, all right. And how soon could this happen?
Yeah, that is some timeline which I'll not be able to predict because it is being run by the Disinvestment Ministry, so they will be able to give us a correct picture. However, it is on target.
Okay, all right. So NMDC has to buy 10% stake in this particular unit. The street has a split opinion out there whether or not it's lucrative or not. Bulk of them believe that why should NMDC be wasting money on this steel plant? But do you want to justify that?
So this steel plant is located in the Bastar region of Chhattisgarh, and the nearest and we are the only iron ore suppliers to the steel plant. We shall be the major iron ore suppliers to the steel plant. It is also a logistical challenge to that extent, and there are other issues related to it. So yes, definitely this was a good idea to retain 10% stake in the steel plant at the moment.
I think the street thinks otherwise. They believe that maybe, in fact, that could be better utilization of this money. But we take your point. 10% is what you're going to be buying. We'll have to wait by in terms of the timing as well as pricing. Talking about divestment, there are various reports that indicate that maybe a JSW Steel, ArcelorMittal or other companies are looking to buy out the NMDC steel plant. Have you heard anything? Is that on the cards?
So there would be various players who would be interested. If you look at this whole, the steel plant per se, and the disinvestment process which is going on. So currently NMDC, being a mining company, is not really, doesn't have the focus, nor does it have the capabilities to run a steel plant. So a joint venture partner or whomsoever comes in will be better equipped as steel manufacturer.
That's correct, Mr. Dev. But have they already approached all? Have they made an offer? Because for a 3 million ton plant to pay 24,000 crores is going to be a tall ask. Has an offer come in from any of these private companies?
So that would be, I'm not privy to that information. That is being run, like I mentioned, it is being run by the Disinvestment Ministry.
Okay, final question then. There is another rumor that maybe in fact SAIL could be merged with this particular unit, or maybe RINL. Have you heard anything like that?
No, I have not heard anything like that.
All right, let's take a quick break on that note. On the other side of the break, we have the management of Mahindra Logistics joining in, Ram Praveen Swaminathan, the MD and CEO of the company, to discuss their business outlook. Stay tuned.